Hello, and thank you for tuning into the channel. Today we'll look at the top 10 best investment opportunities in 2022. Before you begin, be sure to like us on Facebook and subscribe to our YouTube channel for more future updates. Number 10. Roth IRA. A Roth IRA could be the best retirement account available. It allows you to save after-tax dollars, grow them tax-free for decades, and then withdraw them tax-free. You can also transfer the money onto your heirs tax-free, making it a more appealing option than a standard IRA. If you want to take it a step further, you can invest in stocks and stock funds and get the benefits of possibly much larger profits while avoiding paying taxes. Of course, you'll have to put up with the additional dangers that stock and stock fund investment entails. Number 9. Robo-Advisor Portfolio. If you don't want to do any investing yourself and would rather leave it to an experienced professional, robo-advisors are another wonderful option. You simply deposit money into a robo-account, advisors, and it invests it for you depending on your goals, time horizon, and risk tolerance. When you first start, you'll fill out some questions to help the robo-advisor figure out what you need from the service, and it'll take care of the rest. The robo-advisor will pick funds for you, usually low-cost ETFs, and build a portfolio for you. Number 8. Small-cap stocks. The fact that small-cap stocks, equities of relatively small companies, have the ability to grow swiftly or capitalize on an emerging market over time has piqued investors' interest. In truth, Amazon began as a small-cap stock, and investors who hung on to the shares became quite wealthy. Small-cap stocks are frequently, but not always, high-growth stocks. Small-cap stocks, like high-growth stocks, are more risky. Small businesses are inherently riskier since they have fewer financial resources, less access to capital markets, and less market influence. However, well-run businesses can provide excellent returns to investors, particularly if they can continue to grow and scale. Investors, like growth stock investors, will often pay a premium for a small-cap business's earnings, especially if it has the potential to expand and become a major company in the future. And because small-cap companies have such a high price tag, they may fall sharply during a market downturn. If you want to buy individual businesses, you'll need to be able to assess them, which takes time and work. Buying a small business is thus not for everyone. Number 7. Real estate. Real estate is the classic long-term investment in many ways. It costs a lot of money to get started, commissions are costly, and the best gains come from keeping an asset for a long time, rather than a few years. Nonetheless, according to one Bankrate analysis, real estate was Americans' preferred long-term investment in 2021. Real estate can be an appealing investment since you can borrow money from a bank for the majority of the cost and pay it back over time. This is especially popular now that interest rates are reaching historic lows. Those who desire to be their own boss can do so by owning a property, and there are various tax rules that help property owners in particular. While real estate is frequently thought of as a passive investment, if you're renting the property, you may have to do a lot of active management. Number 8. Target date funds. If you don't want to manage your own portfolio, target date funds are an excellent option. As you become older, these funds become more conservative, making your portfolio safer as you get closer to retirement. When you'll need the money, as your target date approaches, these funds progressively move your assets from more adventurous equities to more conservative bonds. Many corporate 401k plans provide target date funds, but you can buy them outside of those plans as well. You choose the year you want to retire, and the fund takes care of the rest. Number 5. Value stocks. Many stocks' valuations have been stretched as the market has risen so dramatically in recent years. When this happens, many investors turn to value stocks as a way to be more conservative while still having a chance to achieve significant returns. Value stocks are those that have a lower price-earnings ratio, which is a measurement of how much investors are paying for every dollar of earnings. Value stocks are compared with growth stocks, which develop quicker and have greater valuations. Because value stocks do well when interest rates rise, they could be a good investment in 2022. In addition, the Federal Reserve has hinted that interest rates may be raised this year. Number 4. Dividend stocks. Whereas growth stocks are the sports cars of the stock market, dividend stocks are the sedans. They might provide good returns, but are unlikely to outperform growth stocks. A dividend stock is one that pays a regular cash payout in the form of a dividend. Many equities pay dividends, although they're more common among older, more established corporations with less of a need for cash. Dividend stocks are popular among older investors because they provide a consistent income stream, and the finest equities raise their dividend over time, allowing you to earn more than you would with a fixed bond payout. One common type of dividend stock is real estate investment trusts. Number 3. Bond funds. A bond fund, whether it's a mutual fund or an exchange-traded fund, holds a large number of bonds from various issuers. Bond funds are classified according to the type of bond they hold, as well as the bond's tenure, riskiness, issuer, and other characteristics. If you're looking for a bond fund, there are a number of options to choose from. When a firm or government issues a bond, it agrees to pay a predetermined amount of interest to the bond's owner each year. The issuer repays the principal amount of the bond at the conclusion of the bond's term, and the bond is redeemed. A bond is one of the safer investments, and bonds that are part of a fund are even safer, because a fund may possess hundreds of different bond types from a variety of issuers. It diversifies its holdings and reduces the impact of a single bond defaulting on the portfolio. Number 2. Stock funds. If you don't want to devote the time and effort to researching individual stocks, a stock fund, whether an ETF or a mutual fund, can be a good alternative. When you buy a broadly diversified fund, such as an S&P 500 index fund or a NASDAQ 100 index fund, you'll get a mix of high-growth and low-growth firms. However, if you own a few specific stocks, you'll have a more diversified and safer portfolio. A stock fund is a great option for someone who wants to be more aggressive with their investments but doesn't have the time or inclination to devote their attention to it full-time. You'll get the weighted average return of all the companies in the fund if you buy a stock fund. Therefore, the fund will be less volatile than if you owned only a few equities. Number 1. Growth stocks. Growth stocks are Ferraris in the world of stock investment. They promise a lot of growth and, with it, a lot of investment rewards. Growth stocks are frequently associated with technology companies, but they are not need to be. They typically reinvest all of their profits back into the company. Thus, dividends are rarely paid out, at least not until their growth stops. Growth stocks are dangerous because investors frequently pay a high price for the stock in comparison to the company's profitability. As a result, when a bear market or recession hits, these stocks can swiftly lose a lot of value. It's as though their unexpected fame vanishes in a second. Growth companies, on the other hand, have been among the greatest performers throughout time. That's a wrap for today's video. What are your opinions on our list? Please share your thoughts in the comments box below. Also, don't forget to hit the like button and subscribe to our channel for more updates in the future.